get started on Chapter 9, Long-Term Liabilities. Long-term liabilities are those liabilities we expect to pay later than a year. Anything we're going to pay within the next year is current liability. Some examples of things that can be long-term liabilities: notes payable, bonds payable, loans payable. Pension liability. Post-retirement health benefits. Deferred taxes. We're going to concentrate with the payable type items. These are very specific, very detailed, upper level accounting, and while they're still considered long-term liabilities, it's not what we're going to focus on. Notes payable, bonds payable, loans payable are all similar. These are going to be liabilities paid later than a year. Generally have an interest rate, a face amount, and a maturity date. The only way to differentiate whether the liability is a loan, a note, or a bond is by looking at the actual piece of paper and seeing what it says on the top. Bonds are the most versatile of these payables. They can be a lot of different types, and the accounting for all of them are basically the same. So we're going to use bonds just to illustrate, but everything we're doing could be applied to that liability had it been called a note payable. Everything would be the same, except it would be note instead of bond payable. Bonds can be unsecured or secured. The difference is whether there's assets backing up the bond in the event of a default, or there is just good faith and credit of the issuer. It could be a term or a serial bond. Term bonds are going to come due at a particular maturity date in the future. Serial bonds will come due at different points in time. We need to know the interest rate on the bond. We need to know the number and the timing of the payments, the maturity date, the face amount, and the market rate of interest. All of these are going to factor into the pricing of the bond. Should have also mentioned bonds can be callable or convertible. Callable means the company can make you redeem your bonds for repayment. Convertible means the holder has the option of turning in the bonds, either for repayment or to turn them into common stock.
Which is the most common?
You can't say, probably just in sheer number, bonds, unsecured term. But all of these are common enough. None of these are rare. So let's say we have $1 million bond. %10 interest. Interest paid at July 1st and January 1st. 10-year. Market rate of interest is 12%. Will these bonds be issued at a premium, at a discount, or at par?
At a discount.
At a discount, that's correct. So I have these bonds to sell. I want to sell them for $1 million, and they're paying 10% interest. I come to you and say, will you buy my bonds? You're going to get 10% interest. The person's going to say, I could take my $1 million and go into the market, and for bonds of this quality with these terms, the market will give me 12%. Why should I give you $1 million and get 10%? The answer is, there's no good reason. So I'm going to say, well, I do want you to buy my bonds. How can I get you to buy? And the person will say, all you have to do is price the bond so that I get a market rate of interest. And you do that by issuing the bonds at a discount. So you say, okay, don't give me $1 million for this $1 million bond. Give me $870,000. I'll give you the interest payments based on the $1 million times the 10%. And at maturity, I'll give you the $1 million. But you only have to give me $870 today. So the person takes out their calculator and they discount the stream of interest payments. Then they discount the $1 million at the market rate of interest. And they find 870 is the right price. They're getting the market rate of interest. So that's how you can always issue bonds at the market rate of interest, even though it's printed, it's going to be a 10% interest rate by adjusting the price. So when the bond interest equals market interest, the bonds are issued at par. If the market rate is 10 and my bonds are 10, you'll get $1 million for it. When the bond rate is greater than the market rate, you'll get a premium. People will pay you more than $1 million to get the market rate of interest. And when the bond interest rate is less than the market, they'll be issued at a discount.
What if the percentage is negative? I just listened for the Japanese. They issue a negative percentage for the bond.
It makes it difficult to calculate.
Yeah.
For people that are having, getting more debits and credits than you want, we'll skip the negative interest rate and its effect on bond pricing.
Why would someone purchase a bond at premium? Because it really benefits the company that's issuing the bond.
Well, when you buy a bond or you sell a bond, for every person who's selling a bond is someone who's going to buy a bond. You always want to get the market rate of interest. By definition, no one will buy a bond of even terms if they're not going to get the market rate of interest. So if the bond is paying a higher rate than the market, they can sell it at a premium in order to generate the market return. Otherwise, why would they sell it? Everybody would want to buy it because that you can get more than the market rate of interest. The only way to adjust for that is by changing the price you sell it. The same way, the only way to compensate for an interest rate less than the market is to drop the price. These bonds are printed with a face amount and an interest rate on it. Those are not changeable. And the market is always changing. So why would someone pay more? Well, this is getting fixed at the moment they buy the bond. Market rates are going to change thereafter. If market rates go up, the value of a bond goes down. The market rate of interest goes down, the value of the bond goes up. So they may be taking into consideration future changes they're anticipating. This is one moment in time, and that's the date of sale. So we have $1 million bond, pays 8% interest a year, 10 years. Interest is paid July 1st and January 1st, so twice a year. These bonds can be sold for $875,388. You could use a financial calculator, you could use the tables to figure it out. But what we would do is figure out the present value of an annuity and then the present value of the maturity amount. The maturity amount is going to be $1 million. And we'll have to find out the present value factor. The present value factor would be 5% for 20 periods. And I should have specified the market rate of interest is 10%. The present value of the annuity is the interest payment. How much is each interest payment going to be? Well, it's going to be $1 million times 8% equals $80,000 divided by 2, since there's 2 payments a year. So it's 40,000 times the market rate of interest of 5% for 20 periods. We would either look up the table and get the factor or use the calculator. We'll get the present value of the annuity, the present value of the maturity value added together, and we get $875,388. That's how much the bonds would be issued for. So we would debit cash, $875,388. Credit bonds payable, $1 million, and debit discount, $124,612. The discount is a contra liability. So the carrying value of the bonds is the face amount minus the discount. We record as a debit to cash the amount of cash we got for selling the bonds. We credit bonds payable always for the face amount, and the difference is either discount or premium.
Do you do the discount on a per bond issuance basis? Like, do you for each like issuance of bond, is there its own account on the discount?
If we're selling a specific issuance of bonds. In these textbooks, it's always treating it as the whole issuance is getting sold together. In reality, you may sell different bonds. This $1 million might be made up of 1,000 $1,000 bonds. And they may be sold over the course of 6 months, different amounts each day. Realistically, we wouldn't set up a separate account for each one. We would probably group it. But for the purposes of this class, we just assume that the whole issuance gets sold in one transaction. Was that what you were asking?
Yes, it was. Thank you.
So once we calculate each payment of interest, once we get that 40,000, cross off the bond interest, because we're never using that number again. Once we've got the 40,000, we don't use this again. All these calculations are based on the market rate of interest. So get the 40,000 and cross it off. Now we know the only interest rate left to look at is 10%. And we always take the annual interest rate and divide it by the number of interest payment periods per year. Here there's 2 periods, so the 10% divided by 2 gives us 5% each period. Since we're halving the interest rate, we have to double the periods. So 10%, 10 years with 2 payments of interest a year becomes 5% for 20 years. If it was quarterly, it would be 2.5% a period and 40 periods. So quarterly, we would divide the interest rate by 4, we'd multiply the term by 4. So any questions about this? So recording this particular bond would be debit cash, $875,388, credit bonds payable $1 million, debit discount $124,612. We want to set up an amortization table. That's what we're going to use to make our journal entries every time we make a payment of interest. So we start off the date we sell the bonds. So let's say we sell them January 1st, 2015. The balance on that date, and when we say balance, we mean bonds payable minus the discount. So the net amount of the bonds, $875,388. Payment 1 is July 2015. And how much is the amount of the interest payment?
5%. 5%.
Not 5%,
Is that 40,000?
40,000. The amount of the payment is specified by what's printed on the bond. So 40,000. And here's what I would do. When I start my table, I just make 40,000 all the way down so I don't get it wrong. How many times do I have to write 40,000? 20 times. Yeah, I'm not going to do it. Now, I do have the table in Blackboard, and it does have on it 20 times. So then we have to record interest expense. Interest expense is going to be the market rate of interest times the previous balance. So in this case, it's going to be 875, 388 times 5%. Or 43,769. The discount amortization is the difference between the interest expense and the payment amount. Or 3,769. Then that discount amortization gets adjusted to the loan balance. Do we add it or subtract it? We add it. Now, how do we know to add it? There's an easy way to know this. Whatever this balance is, when we get to the last payment, that has to become $1 million. So if it's starting out less than $1 million, that gets to $1 million by adding the discount amortization. So 879, 157. Payment number 2 is January 2016, and it's going to be 5% times 879, 157. Is interest expense going to go up, stay the same, or go down? Go up, right? Because if the balance goes up, and we're timesing a bigger number by the same percentage, the interest is going to go up. Does everybody see how the table works? If you're good in Excel, you can see it's easy to format. The payments are just one more than the previous one until you get to 20. It's either going to be January or July, alternating. 2016, 2016, 2017, 2017, and so on. This is just 40,000 copied straight down. This is going to be 5% times this. So this is going to be 5% times this. This equals that minus that. And this equals this plus this. Does that make sense?
Mhm.
Now the journal entries, 7/115, we're going to have interest expense, 43,769, credit cash, 40,000, credit discount, 3,769. So really what's happening is the bonds payable are staying at $1 million, but we're reducing the discount. So when we reduce the discount, the carrying value goes up because it's a smaller number we're subtracting from the million. 1/116, debit interest expense, 43,958, credit cash, 40,000. Credit discount, 3,958. And so it's going to be the same three accounts. Cash is always going to be the same, but interest expense and discount will change each payment of interest. Now let's say we do calendar year financial statements. So the end of the year is 12/31. This entry, we're actually going to make 12/31/15 by debiting interest expense, crediting interest payable, and crediting discount. Same amount, but instead of cash, we credit interest payable. Then on 1/1/16, interest payable and cash. So 43,958, 40,000, 3,958, and then 40,000 and 40,000.
So what is the other entry then, if this entry is calendar year, the one on the right, the one that you have 1/116?
This one is the entry we would make based upon when the interest is paid. However, since our year ends 12/31, we need to show the interest expense as of 12/31. So we'll make it on 12/31, but we're not actually paying the interest. We'll credit interest payable. And then on the next day, we'll actually pay it. So if you could do that, that's what we'll put on the test.
20 times or just
You're gonna put the calendar year or the other one?
I
You're
mean,
talking about it in general.
In general,
okay.
recording the bonds, recording each payment of interest, making a couple of lines in the table so you have the numbers to use. Realistically, I don't have to ask you to do this.
I like that one.
You like this one. So if I don't ask you to do this, but I ask you for the journal entry, the way you get the journal entry is by doing this.
So I still
I
have
would have to do it.
Yeah, they both go together. You need this to get the journal entry, but the reason we do this is to get the journal entry. So you have to know how to calculate this and how to take this and put it into the journal entry. I mean, this is, for all we've seen so far, I think is fairly straightforward, unless accounting. Not a whole lot of fancy debit credit stuff going on. It's pretty straightforward. In this class, do you ever remember Michael Dukakis? He ran for president a number of years ago. He was at home, he was on the couch reading a paper, and his young daughter asked the mother something about medieval history. She said, "Oh, honey, I can't help you. I don't know anything about that." So she goes, "All right, I guess I'll fake it." She walks past her father, and her father says, "Sweetie, why don't you ask me?" And she says, "Because I don't want to know that much about it." So I've been trying to give you not more than you want of accounting, but like the minimum you have to have.
I know you have good information.
Yeah.
And I appreciate
Yeah, thank you.
it. I just have to get
What do they say? The path to hell is paved with good intentions? Okay, so any questions on long-term liabilities?
I would like to put in a mix. So could you please just say how you came up with the interest expense and the discount amount? These
Okay, so that minus that equals that. 43,769 minus 40 equals 3,769. Are you in Excel now?
Yeah.
Okay, so you can see how to format that.
Yeah.
Okay, now how to get this? $5 times the previous balance.
But 5%.
5%. Getting something different?
No, it's give me. Is it 819,388?
Which one?
The balance, the first bar.
875,388.
Plus 5.
388, right?
Yeah.
give me 43,769.
Yeah. that's
43,769. The spreadsheet is in Blackboard, so you can always compare it.
And is it with the equation or just number?
Well, if you print it, you're just going to see the numbers. If you open the spreadsheet and go to the cell, it'll give you the equation.
Yeah, okay. I thought it just printed as a copy, not that.
Right, if you download it, you can see the cell formulas. Yeah. No, I didn't handwrite every one of the numbers. I did it for one line, then copied it down.
Yeah, just one that's gonna be enough.
Yeah. But that's how we get it. This is just copied straight down. That's equal to the previous balance times 5%. That's equal to interest expense minus the payment amount. Any other questions about chapter 9? How about anybody playing at home? Okay, then I'm going to stop the recording. We'll call it a day.